IVM.
As asset allocation, which is not taught in our schools or colleges, but people learn it the hard way. What is asset allocation? The right set of exposure to these categories which I spoke of: equity, debt, commodities, REITs and WITs, at the right time in the right proportion. And so people get it right sometimes in terms of timing, but they don't get it right in terms of proportion.
Correct.
And so asset allocation is a simple term for allocating the right asset in the right amount at the right time. All three are important.
Yeah.
Now, that's asset allocation. Diversification, when we generally talk about, it's within an asset class. For example, you decide that 35% to 40% you want to be in equities. Now, within equities also there is large cap, mid cap, small cap. There are sectoral funds like auto, infra, FMCG, tech, banking, of course. Then there will be diversified portfolios of equity funds. There will be focused portfolios. So based on your risk appetite, you choose those 5-7 funds and you diversify within the asset class.
Folks, welcome to Paisa Vaisa. I'm your Anupam Gupta, B50 on Twitter. I'm happy to welcome back Chintan Haria, Head Investment Strategy, ICICI Prudential Asset Management Company, one of India's leading AMCs, and we're going to talk about mutual funds and market trends. Chintan, welcome to Paisa Vaisa. Thank you so much. It's great to see you again. Last time you were here in, I think it was October 2021. That was online. Great to have you in person. You're talking about the NASDAQ 100 index fund. So thank you so much for doing this for our listeners.
Thank you. And it's been a long gap. I hope the next one is much, much earlier
I
for the
hope so
benefit
too.
of listeners and viewers. And you're doing such a great job. And thank you for inviting us.
Thank you for your kind words. And I hope it's back in the studio again. So, Chintan, let's start with flows, okay? And especially only from a retail investor's point of view, because that's what our audience is. And, every month we've got new highs of SIPs, this, that. Can you just give an overview of what's been happening on retail investor flows in equity and also in debt?
Sure. So the first thing is, if we look at what's aided the growth in India of financialization, is the ease with which investors can invest today. That's thanks to the UID or the Aadhaar linked opening of accounts. And that has made it easier also with the kind of work that people and your firm are doing. The understanding of investors in general across India, and I've been fortunate to travel, I think, the length and breadth of India. I see the kind of questions improving meaningfully even in Tier 2, Tier 3, Tier 4 cities, which essentially means the digitization and the outreach has been extremely good, with now investors wanting to participate in India's journey. Also, it helps that last 10 years, India has seen a good run as far as markets are concerned. And SIP as a medium, what you spoke of, it's something which will keep growing as it works well for investors. They earn every month, they save every month, and they invest every month. And SIP also allows investors to stay invested for longer. A little later in the day, we'll speak about Freedom SIP. But I do believe that this journey of less than 1,000 crore SIP in 2013 to today, almost touching 16,000 crore SIP, is something which is just start. And over the years, we'll see this grow. So the flows are strong. And we are very happy to say that today mutual funds account for about 9% of the total market cap. Foreigners account for about 17.5% of market cap. Just about 15 years back, mutual funds were less than 1%. So you see the journey of 1% to 9%. It's thanks to retail investors. It's thanks to the power of the Indian savers. And I think this will continue.
Yeah, what's been happening in debt? Because there you had that change in the income tax laws in the end of March, and now we are sitting here in September. 6 months have gone by. What's been happening there?
So as far as pure debt is concerned, yes, the taxation change has meant that investors probably have all the investable instruments in debt at par on taxation. And so they're making their choices. The flows arguably have slowed down on the debt side, but the good news is that we at ICICI Prudential Mutual Fund were proponents of hybrids as a category where you have equity, debt, multi-asset category where you have gold and REITs in which as well. We've been proponents and we have a large share of our AUM in hybrids and that works well for the investors. And so via the hybrid schemes, you get exposure to debt. So pure debt, yes, has slowed down understandably so. But through hybrids, if investors continue to get exposure to debt, that's also a sensible move as far as an efficient way of investing in debt is concerned.
You've given me an opening into my next question because it's related to hybrids, which is the category of balance advantage funds and dynamic fund, because this is an asset class which, and you've been in the industry for almost 2 decades, you would know that the awareness about this was not there so much, say, maybe 10 years ago, 15 years ago. Now it's become a meaningful size. What's your view on that? I mean, and the awareness that's come up with a lot of people that, there's BAF and there's DAF as they're called.
So I've been lucky that in the last 18 years, India has seen, especially the mutual fund industry has seen significant changes in the availability of products as well. ICICI Prudential Mutual Fund being a pioneer in many of these launches. And I remember way back in 2005 when I started my career, we used to see a pattern where investors used to invest when the markets are high, take out money when the markets are falling, which was actually contradictory to what they should be doing for their wealth creation. And so we thought, why not devise a fund? And in fact, globally, I don't think such a fund is available, wherein if markets are expensive, you reduce equity. If markets are cheap, you increase equity, which is the balance advantage fund category. Today, it is a category after the 2018 SEBI categorization. But prior to that, it was simply a balance advantage fund. We came out with it in 2007. It took about 5-6 years for people to appreciate what it could do from an investor in fitment perspective in your overall asset allocation. But now, as you know, it is one of the largest categories. And we do believe for most investors who are looking at investing in a single instrument, equity and debt, and also based on market valuations, move the equity level. It's very difficult from a taxation, efficiency and knowledge perspective for an individual investor to do it. We bring in almost 15 years of experience on that platform. And so this entire category of hybrids which you spoke of, and there are multiple funds there. I'll come to that. What are the opportunities available there? It is a very good way of investors to participate in the market. Generally, before 2006-07, investors had a view that either it's equity or it's debt. But a good mix of equity and debt based on market valuations, it was the balance advantage fund category brings in. Now the multi-asset category is also becoming popular. Equity savings category is also becoming popular, and we made a few tweaks there as well. So I think multiple opportunities are available for the investors, and it's a good start. And with more and more AMCs bringing the products on the hybrid category, I think it is helping the ecosystem to develop. So it's always we, along with our peer group funds, reaching out to a larger number of people and being able to garner more inflows.
Yeah, let's talk about that, because you said we'll talk about it. I think it's a good time right now to just get into this category. I still talk to a lot of people who are not even aware of it. I don't know what's the total size of BAF and DAF together, but I think I recall, what was it? I think it was during the lockdown that one NFO from either a balance advantage or a dynamic just raked in some major amount.
Yes, it was from a public sector AMC, yes.
Yeah, so, and it's 3 years since then.
Yes.
Yeah, so for our listeners who are not aware of what these categories are, could you just explain that?
I'll try and make it as simple as possible. Now, what is the pain area? The pain area is when markets are expensive, you need to be low in equity so that when markets fall, you don't lose money. And when markets fall, you need to have the money to invest. Not just the money, but the courage to invest. Because when markets fall, all the negative news comes in and you are basically pushed away from the markets. This greed and fear, this worries at different points of time when markets are high, markets are low, is what prevents people from participating in the market in the long run. It also pushes some people out of the markets when markets fall and you lose money. Because losing money has the biggest pain, right, for most investors. With that thought, the balance advantage fund category or the dynamic asset allocation fund. So dynamic asset allocation fund and balance advantage fund are two names for the same category as far as categorization is concerned. What do these funds do? In general, for most AMCs and in particular for ICICI mutual fund, it's a very simple model-driven product wherein based on market valuations, in our case, it's on the price-to-book model. For the last 15 years, we've been running it on that. We basically have a situation wherein if markets keep falling, you keep adding to the equity level. And as markets keep going up, you do profit booking. The advantage of this is, and I'll quote an example from March 2020, which is the recent sharp fall that we saw. It's not recent anymore, and the pains of COVID are also thankfully now behind us with all the vaccinations and the pandemic getting over. If you look at what happened in February and March, in February 2020, markets fell 6-7%, and in March it fell further 20%. Very sharp fall, and most people would be worried. Most people would be afraid to put more money because we were in a lockdown and we didn't know what will happen, what impact will the pandemic had. At that time, the Balance Advantage Fund category, and again I'll speak for ICICI Prudential Mutual Funds, the Balance Advantage Fund, we went from 42% to 49% invested in February 2020. And then in the sharper fall, we went from 49% invested to almost 77% invested.
Wow. Okay.
So you can see the 28% jump of equity level at what we now know in hindsight was the bottom of the market in March 2020, and after that it resuscitated. None of us obviously predicted that from 7,700 at the index level on Nifty we'll reach where we have.
Or had the courage to invest at that
Exactly. So, but the valuations were telling us that markets are cheap. And so we de-linked the greed and fear, because even as fund managers, even as people who are managing money in fiduciary capacity for investors, you tend to get afraid. But if you have an anchor of a model which is strong, we were able to do that, and that has helped the investors. So, and the reverse is also true. As the markets kept on going up, we've brought down the equity level, and we are somewhere around the 38-40% equity level range, which essentially means that you are at a lower end of equity level, and your risk in the fund, if markets correct whenever they do, is that much lesser. Yeah. So that's the simple trait of a balance advantage fund. Buy low, sell high. And I think it's working well for investors in terms of their core allocation. And from an asset allocation perspective, you build a strong foundation through allocation to balance advantage fund. And then there are many alternatives you have of fully invested equity funds to build the aggressive part of your portfolio depending on your risk appetite.
Yeah, I just wanted to add in on the debt side. I mean, you spoke about the equity side, obviously, about how markets had tanked in March 2020. The debt category does not see such sharp falls, but a balance advantage or a dynamic asset allocation also gives you the advantage of having debt in your portfolio. You just talk about that.
Thanks for asking me that question. In fact, while you did mention that debt does not move as much, but in April and May 2020, we saw debt markets also get dislocated meaningfully. There was meaningful pain in the debt markets, and essentially there were credit papers available very cheap because yields had gone up very sharply. And in the balance advantage fund, because there was cash available, because there was investment capabilities available, we were able to basically take advantage of those credit papers also, which were mispriced, to the advantage of investors. So the good part is that even on the debt category, if yields go up in a particular category, we've seen that happen in floating rate as a category. When interest rates have gone up, they've become more attractive. We saw in credits at that point of time, there was a dislocation in the market. The balance advantage fund category in its debt portion, and in general the debt funds, can take advantage of that. Unlike in equity markets where the gains or the falls are extremely sharp and 20-30% is possible, in debt markets it's slightly lower, but then with the lower risk reward, these falls and upticks, if you can capture, it adds to the yield of the investors.
Yeah, I mean, and I think iPru's got the entire suite of products. So you would have equity, debt, BAF, DAF. You have smart beta also, I guess?
Yes.
And passive and everything?
Yes. I think if I look at the history of last 25 years, starting from arbitrage fund as a category, I think our arbitrage fund is now more than 2 decades old, or almost 2 decades old, if I can say so. So every time there is something which is there to offer for the investor. If there is a demand, there is a supply. If there is investors who are looking at a particular category, or if we feel something fits well for the investor category, like on the passive side, we believe that low volatility is a good fit for investors for the long run. So in 2016-17, we thought of it and we brought out India's first smart beta low vol strategy, which is ICICI Prudential Low Volatility 30 Nifty Low Vol ETF. Yeah. And it took time, 4 years, but as investors understood the power of low vol, Now it's gathered AUM and it's doing well for the investors in terms of their fitment to the portfolio.
Yeah, I mean, when you talk about these categories, it reminds me of automobile or FMCG, where at every price point for every consumer taste, you got some product out there.
Yes.
Mutual funds have also become like a very consumer product. What's the future out here? Both in terms of penetration, right? I mean, India has still got some way to go. I had a guest on the podcast who said that we are today in 2023 at the level where the bank system was in the 70s when it came to CASA, when it came to savings deposits and stuff like that. So what's your view on that? Okay. And second is, are the products saturated, or is there even more room to experiment?
So in India, I think not just in the case of mutual funds, every possible financial service or financial instrument, every possible goods, be it automobiles, like in automobiles, we are touching about 41 lakh cars this year, passenger vehicles. China sold in a lockdown year last year 2.6 crore cars. So while we are talking of financialization and mutual funds, of course, every product category is going to see a growth over a period of time as we grow larger as an economy. Specifically to mutual funds, today we are in a phase where the understanding of mutual funds, and like you mentioned, every investor based on their risk appetite has a potential fitment, be it on the active side, passive side, alternate side. And so as people want to, depending on their risk appetite, create a portfolio, they are looking at mutual funds as a way to execute that in a professional manner. And I think due credit in terms of the regulations as well. Today the regulations are strong, and that has helped also the industry to grow.
Yeah.
So I think the base has been set, and as far as our AUM is concerned, out of the 800 lakh crore savings that we have as a country, around 40 lakh crores is in mutual funds. And the good news is that on a $3 trillion economy, or $3.5 trillion today, reaching up to $5 trillion in a few years' time, our savings rate, even though it is coming down, will ensure that there is enough room for all financial services to grow in India, and mutual funds would also continue in their journey. And as long as we manage money well in fiduciary capacity in the interest of the investors, I don't see a reason why the industry should not keep growing.
Nice. Chintan, let's talk about past and future of equity and debt. What's happened so far? How's the performance been of both these asset classes, and what's your outlook going forward?
So this is again a question which keeps coming, right? That what should one expect from equity markets? What are the returns that one should expect from debt markets? In general, ballpark, if we look at the past, and probably you can crystal gaze into the future as much as we can, debt markets by definition, with the risk and reward that they provide, should be able to meet inflation as far as the returns are concerned. So that's where whatever is the inflation rate, you'll have risk-free rates matching that with the central banks, and the debt markets will mirror that. So if inflation is high, you'll have higher returns for debt. So in very simple terms, whatever is the inflation, you can expect that the debt markets to probably meet the inflations, and there will be years where it will be higher returns, there will be years where they'll lower return. But in the long run, that's how one can expect a slightly more return than inflation or around inflation returns. If you look at equity markets, what essentially do equity markets provide? They provide investors with a way to invest in the growing profitability of corporates. And the growing profitability of corporates, in turn, is dependent on the sales which the corporates do, which is dependent on the growth of the country. So a higher GDP means a higher sales, means higher profits, and higher market cap. That's at a country level, a very simplistic formula. And if, as we are expecting Indian real GDP to grow by 5 to 6%, inflation we can't predict, but let's assume 5 to 6% inflation, then we are talking of, at least for the near foreseeable future, anywhere between 10 to 12% GDP growth.
Yeah.
And in the past, we've seen last 30 years that the returns on equity markets in general, now some funds will do better, some funds will create alpha, some funds will not create alpha. But if you look at, let's say, the ballpark benchmark returns for the indices, the large cap indices, they somewhere have a link to the GDP growth. And so from that perspective, whatever is your assumption of GDP growth, I think equity markets should deliver to you that much. And if the fund manager does a good job, or you are able to select the right set of sectors, themes, and do the right things for your portfolio, then you can add alpha also.
Yeah, so I'll get to that part after this small question, because it's a topic which a lot of people are still, they get confused. It sounds like very heavy duty jargon. If you could just help us with that. Diversification and asset allocation. You spoke about equity, you spoke about debt. It's very important for our listeners to understand both these concepts. Could you just help us with that?
So, generally they are two sides of the same coin is what people understand. In general, when we speak of asset allocation, we say, okay, what are the available opportunities based on your total wealth that you can invest in? Not everyone can have a real estate investment portfolio. You may have a house, but you may not have as much wealth that you can have physical real estate as your investment vehicle, because it's generally heavy duty. But so if we leave out physical real estate or physical assets aside, which is also a part of asset allocation, in financial assets, you have equity, debt, you have commodities like gold, silver, ETF, and the sovereign gold bonds, and you have REITs in which today. So you have alternatives around that, and of course fixed income in various forms which are outside of mutual fund also.
Yeah.
So as asset allocation, which is not taught in our schools or colleges, but people learn it the hard way. What is asset allocation? The right set of exposure to these categories which I spoke of: equity, debt, commodities, REITs and WITs, at the right time in the right proportion. And so people get it right sometimes in terms of timing, but they don't get it right in terms of proportion.
Correct.
And so asset allocation is a simple term for allocating the right to the right asset in the right amount at the right time. All three are important.
Yeah.
Now, that's asset allocation. Diversification, when we generally talk about, it's within an asset class. For example, you decide that 35% to 40% you want to be in equities. Now, within equities also there is large cap, mid cap, small cap. There are sectoral funds like auto, infra, FMCG, tech, banking, of course. Then there will be diversified portfolios of equity funds. There will be focused portfolios. So based on your risk appetite, you choose those 5-7 funds and you diversify within the asset class.
Yeah.
So you can choose them interoperably, but the fact remains that asset allocation is a broader term in terms of which asset class you put how much percentage and when, and you need to keep it, let's say, it is not a stagnant number, because based on the market valuation, it has to change. Now, how often does it have to change is what the question is. If you're investing in a DAF category fund or a balance advantage fund category, the fund manager may be doing it on a daily basis, weekly basis, monthly basis, depending on their model. We at ICICI have a model which basically changes daily. And so you're getting the benefit of each market move which is happening on a daily basis. So the point being, as an asset allocation, you decide where you want to invest, and as a diversification within the asset class, where all you want to diversify your portfolio.
Yeah, so I want to go back now to the previous question's answer that you gave, because there's a line that you said out there, if you're able to choose the right fund manager, right? So I want to bring in the big elephant in the room, so-called the passive versus active debate. As a fund house that has both products and in depth also, you've got passive in depth, you've got active in depth. What's your view on this here? Because I don't know, sometimes I feel that you can't, and this is a question that even the West has grappled with. If you have passive, then it's a bit of a distortion in the markets also. At the same time, active has not been beating passive. What's your, I wouldn't say advice to listen, but what's your view on this topic?
So active not beating passive has been the case in, if you look at the SPIVA report, which is the S&P reports which keep coming every year. Yes, in the large cap space in US, generally we've seen in the last 4-5 years, it's been difficult for the markets have been narrow there, so it's been difficult for the active to beat passive. That trend is changed a little in the last 2 years, where value started to outperform growth. And if we look at India specifically, my 18-year career, I've seen 2005 to 2008 active beat passive.
Yeah.
2008 to 11 passive found it easier than active because the markets were what they were. It was a weak market scenario. Again, 13 to 17 active did better than passive because the markets were doing well, economy was doing well. 17, 18 onwards, we saw a correction, and 18 to 21, it was the top 10 names in India, accounting for a large part of the positive return, if I can say so, and the rest of the market was negative. Obviously, fund managers with a diversified portfolio suffered at that time. And again, 2021 to today, if we see, the active has done better than passive. So it's a cycle. I wouldn't say you need either or. Have both in your portfolio.
Yeah.
Selecting which one is your choice, but you need to probably know a bit more yourself if you are going the passive way.
Yeah, I think that's the main takeaway for listeners, that it's never going to be either or. You need to have both. You need to figure out what are your requirements. I mean, I just don't see how one can be at the cost of the other. Just doesn't make sense. So, okay, extended concept and last couple of questions. Talk to us about the iProof Freedom SIP, because that kind of brings a very new and innovative investment approach to the way that we look at mutual funds. Talk to us about that.
Sure. So, much like how Balanced Advantage Fund as a category ensured people don't have to worry about when to invest, how much to invest. When we were looking at SIP as a medium for investors to invest, we felt that we could add a little bit more there in terms of bringing a formal way of investors to think long term. Because typically when you think of SIPs, people were like, okay, I would do a 3-year SIP, I would do a 5-year SIP. But we added an element that think of your goal. In 8 years, you'll have a goal. In 10 years, you'll have a goal. You'll have 12 years a goal.
Yeah.
How much money at that time based on inflation you will require for that goal? It could be simply after 12 years to run your day-to-day house, you need X amount based on the inflation that is there. And you reverse calculate it, we realized that what most people were budgeting today in terms of their SIP and expecting the outcome, they probably need to put a lot more in SIP today. That means they need to save a lot more. So we simplified that process by having a medium called as or a feature called as the Freedom SIP. What Freedom SIP is, it's very simple. You have a source scheme in which you basically start your SIP. The amount will be decided by actually your goal.
Okay.
So after 8 years, if you have a goal and you know that you need, say, X amount, based on a certain market return, you can reverse calculate the amount of SIP that you need to put, or the SIP, monthly SIP. And then it can be weekly also, you have those options. So you put that money on a monthly basis. After 8 years, we don't know how much market will give, but there's an assumption that the market will give. And if let's assume the market gives around the assumption, you have a corpus created in your source scheme. And then from the source scheme, you can utilize that amount for the goal that you need. If you need that amount to actually give you cash flow on a monthly basis, there's a systematic withdrawal plan which you can decide upfront today. So it's in 3 parts. In part is, one, you decide the amount first based on your goal.
Yeah.
It could be 8-year, 12-year, 10-year, you have options which are there. Then once you've decided the amount, you decide the source scheme. The source scheme will be decided by your own risk taking ability. Generally, people say, since you're doing SIP, do it in a fully invested scheme. I don't see a harm in you having your source scheme also as Balanced Advantage Fund and your target scheme also as Balanced Advantage Fund. So what will typically happen in the life cycle is, you start your SIP with the amount that is now known to you in a source scheme. You allow that amount to grow over time with market. Because there's a goal attached to it, you will not be tempted to take money in between. So it allows you to participate longer. So we are trying to let's say, take care of many of the hindrances to long-term wealth creation which investors have. They are longer term, will take it care of. The longer term money which they will keep, it will accumulate. Then at the end of that, from the source scheme, the money goes to the target scheme. And if you have Balanced Advantage Fund as your source scheme, you can continue with that as your target scheme, not a problem. You choose your source and target scheme. There are multiple combinations possible. And then once the money goes into the target scheme, arguably the target scheme will be a lesser risky scheme like the Balanced Advantage Fund. Generally, it should be that way. You have the option of having whatever you choose. That target scheme, you will start getting flows based on whatever you've chosen as the amount of flows that you want.
Sure.
So this entire life cycle of the feature is essentially packaged in the form of a feature called Freedom SIP.
Okay.
It's actually trying to put 3 or 4 things together. It's nothing, let's say, revolutionary in terms of what it is doing. It is allowing investors to look at the variety of options which mutual funds already had, packaging it together and allowing them to participate in the long run. That's what Freedom SIP is.
If I just take a live example, maybe of someone who is planning for a child.
Correct.
And knows that 5 years later he'll need to plan for school fees.
School fees.
The child goes into
Yes.
school, say after second year or third year.
Yes.
So how will this work then? So
it's a good. Let's say you think of it and say maybe in 5 years time, typically 5 years time, say 3.5, 4 years of age, the child needs to enter school. You need typically 1.5, 2 lakh rupees a year, depending on which school, of course. But that's the general range, at least in Bombay. And so you reverse calculate that every year you'll need 2 lakh rupees, and you need to start getting that much. So how much money you need to put today? And once you've done the reverse calculation, you put that money in the SIP. At the end of 5 years, that money can shift or continue depending on your own situation at that time. And that money then corpus is available to you for taking out most people pay annually. So you can take it out annually and your child's fee is taken care of. And that load as far as your yearly annual finance is concerned, to that extent is reduced, and you've planned it well in advance, so it works well for investors.
Every March or whenever the term starts, you don't have to think of getting that money out. You just
it's already there. It's already there. You budget it for it.
Yeah, wonderful. So you spoke about, there's one thing that you mentioned while talking about the Freedom SIP was about the structure prevents you from prematurely withdrawing, redeeming or selling a mutual fund, right? Last question on this episode. Tell us about the common mistakes that retail investors do when it comes to mutual funds. Okay, I'm not talking about equity or debt, but generally, because it's a very powerful investment that they have.
Yeah.
And yet
So I'll extend this the question to the fact that it's not retail only, but I've seen retail, HNIs, even institutions, fund managers, all go through the same issues at times, wherein after a market failure or your strategy failing, sometimes you end up changing the strategy. So what we have learned and we have implemented, and due credit to our investment team, that we've stuck to our investment process and not changed after failure, and then success has come, because markets are cyclical. So what investors don't realize is, in markets, different cycles are possible, different styles are possible. There are so many sectors, so many stocks. All you need to do is have a sensible way of investing, and in the long run, you'll participate. Now, what are the common mistakes? In the interest of time, I'll probably just list them. The common mistake is not starting to invest early, because we are not taught finance in general early. So I'd say to all the listeners that you may be young yourself, or you may be having younger children. You can do an SIP in the name of a minor child also, no problem.
Correct.
So when the child becomes a major, or when the child learns or is capable of understanding, you already have set an example as far as savings is concerned. So it's a great way to gift a child also on their birthdays. Second is, we don't size well. In other words, we feel that based on today's savings, I'm putting an X amount, I'm very happy today. What we are not able to envisage is that what is, say, X today, I'll require 3X after 20 years, 30 years. In terms of the amount of money that I need. And there I need to invest more. So one is start early. Second is invest more. Third is, many people feel there are so many options that I have in mutual funds, I get confused. Which is where it brings me to the most important point. We have a family doctor, we have a family chartered accountant, but probably the role of an advisor for those who don't understand finance is today probably less understood. So if you can have a good advisor, or if you can have a good person to advise you what you need to do with your money, that also helps you a lot. So the mistake is that not identifying that right person. Actually, people don't try to identify. They want to self-learn at times, which is not good for them. And the last part, you do not keep your money for long term. Once you've committed to something, keep your money for the long run. As long as you've chosen well, and you don't need to get it right in terms of the best fund all points of time. It's not going to happen. No one is able to pick the best fund at all points of time. But if you are consistent in your investment and you have a well-diversified portfolio, I think over a long period of time, you'll anyways make money. So start early. Don't wait as far as finding the right advisor for you is concerned. Invest in sums which are important in terms of the size of your investment, and then allow your investments to grow over a long period of time. These are the 4 things which you need to take care of. Other than that, nothing is in your hand in terms of what the markets will do or what internationally will happen. Don't probably worry too much about many things that we keep hearing about. It's not in our control.
But what you just said, it's about, being consistent and doing these very small things and sticking with them, making it habit, right? What do you think?
Yes. It is exactly that. So in bull markets, of course, there are many people who would claim that I am doing better than the other and I'm also capable of being a fund manager. It's when the full market cycle happens. So give anyone 8 years to prove themselves in terms of whether they are good or not. 8 years is such a long period of time that most people feel that they not ready to give that much time. But yes, I do believe that if you keep it simple and long term, you don't have to worry as far as markets are concerned. Last 30 years data, if you look at 1991 when India got liberalized to today, except for a COVID bump, every year we've grown irrespective of wars, irrespective of the governments, irrespective of everyone wants to see India grow.
Yeah.
And it's ultimately the entrepreneurial spirit of the 140 crore Indians which is showing today. And all stars are aligning today for India to see the next 10 years because 1, China is slowing down, 2, Europe is aging, US has its own debt crisis, which is the country, 5th largest country we are, and we have the resources, we have our own food, we have our own energy. So it's very easy to be saying that India has done so well in the last 10 years, but I don't see a reason why whatever geopolitically or whatever resource-wise we are seeing, India cannot do well for the next 10 years, 15 years, 20 years as well. Markets will have their cycles, but we should have faith in India, and I think if we have faith in ourselves, we'll do well. Thank you.
There's not much required. I mean, this is simple and basic stuff. Okay, Chintan, we are done with the show. I just want to, ask standard questions to all our guests who come in out here is in the form of content recommendation to our listeners. Right? Anything that you're watching or reading that you'd like to share?
So these days, a lot of emphasis is going on semiconductors, and of course, this podcast is possible because of semiconductors. People are listening because of semiconductors. Yeah. So there's a book called Chip Wars, which came in 2022. Beautifully lists the history of the semiconductor industry and what's happening right now. It's important geopolitically also for those who probably are worried there may be a war between A and B because of the large semiconductor manufacturing country that is there. I think it will answer a lot of their questions. So I think that's something which they should probably look at or read for those who like, it's called Chip Wars. And apart from that, I think for those who like private equity, there's a book called Power Law which has come in 2022. Again, it will beautifully illustrate how US private equity became a guiding force, driving force for innovation in semiconductor and in general allowing entrepreneurs to grow without having to wait for large money coming from large corporates. And that's how the innovation journey started 40 years back in US. I think these two are something which come top of my mind. It will be differential reading. Otherwise, typically the financial books and all most people would be knowing, right? Harvard Marx, Mastering the Art of Market Cycle, 100% you should read. Psychology of Money, 100% you should read. But these two are something which come to my mind. Thank you.
Chip Wars and Power Law. So folks, with those very good book recommendations, that is a wrap on this episode of Paisa Vaisa. My guest, Chintan Haria, Head Investment Strategy, ICICI Prudential Asset Management Company Limited. Chintan, thank you so much for doing this for our listeners.
Thank you so much, and I look forward to doing it again soon. Thank you.
Lovely. Look forward to that. Thank you.
IVM